Raising money for your startup but don't know whether to use a SAFE or a convertible note? Both SAFEs, which stand for Simple Agreements for Future Equity, and convertible notes allow startups to raise money without setting an immediate valuation, but they operate differently, and choosing the wrong one could cost you equity, control, or even force you into debt. Today we're breaking down how SAFEs and convertible notes work, key differences and risks for founders, and when to use each instrument for fundraising. So let's dive in. Hey everyone, I'm Corey, a startup lawyer helping entrepreneurs decode law, technology, and innovation. Today we're breaking down SAFEs versus convertible notes, two of the most common early stage funding instruments. Choose the right one and you protect your company. Choose the wrong one and you could dilute your equity faster than you expect. If you're raising capital for your startup, this video is a must watch. So let's get straight into it. Here's what we'll cover in this video. What is a SAFE? What is a convertible note? Key differences and legal implications. Which is better for your startup? Common mistakes to avoid when using these funding tools. Now let's break it all down. First, what is a SAFE? Introduced by Y Combinator in 2013, SAFEs stand for Simple Agreements for Future Equity and are a founder-friendly way to raise capital. The key features of a SAFE: there's no repayment obligation. Unlike debt, if a startup fails, there's no money owed to investors. SAFEs have no maturity date, so there's no pressure to raise a follow-up round of financing on a fixed timetable. SAFEs convert into equity later, so investors get stock when a Series Seed or other priced round at a minimum dollar amount happens, and this is typically referred to as a qualified financing. Usually, SAFEs include a valuation cap or a discount. Investors get a lower price per share than new investors in the next round based on the valuation cap or the discount. It's best for founders who want a simple, fast way to raise capital without the risks of debt. Okay, so next, what is a convertible note? A convertible note is a short-term loan that converts into equity later. It's been used for decades and it gives investors a bit more protection than SAFEs. So the key features: convertible notes are structured as debt and investors earn interest, typically 4 to 8%. It has a maturity date. If the startup doesn't raise a follow-up round in time, investors can demand repayment. It converts into equity later. Like SAFEs, convertible notes convert into shares in the next qualified financing round. Convertible notes include valuation caps or discounts, and this ensures that early investors get a better deal than later ones. It's best for startups that expect to raise a price round soon and they're comfortable with debt. It's also great for startups who are navigating a shaky economy and may have raised a prior round and have current market feedback that their current round, if they raise in the future, may be lower than their prior round, which is called a down round. In that case, some startups would choose to raise potentially convertible debt with the interest rate, and I've even seen scenarios where more mature startups will go back and raise a SAFE even if they're beyond a Series B or Series C round, and we've seen numbers ranging in the hundreds of millions potentially for the right startup. That's not typical, but I did want to highlight it. Okay, next, SAFEs versus convertible notes. Let's break down the key differences between SAFEs and convertible notes so you can quickly understand which one fits your fundraising needs. First, the structure. A SAFE is not debt. It's an agreement that converts to equity later. A convertible note is debt. It accrues interest and has a repayment deadline. Second, the risk of repayment. With a SAFE, there's no repayment risk. If your company never raises a follow-on round, investors don't get their money back. With a convertible note, there's a repayment obligation. If you don't raise another round before the maturity date, you could be forced to pay investors back. Third, complexity. SAFEs are simpler, they have fewer legal requirements, and they're faster to execute. Convertible notes, they're going to require more negotiation. They involve interest rates, maturity dates, and legal terms that need to be carefully structured. So the key takeaways here, that SAFEs are great for early stage founders who want to avoid debt and keep fundraising simple and fast. Convertible notes are better when investors demand repayment protections or when a startup expects to raise a price round soon and is comfortable with the repayment timeline and the risks associated. Now let's look at common founder mistakes when raising early stage capital. Mistake number one, stacking too many SAFEs or notes. This can lead to unexpected dilution when all the SAFEs and/or the notes convert at the same time during qualified financing. Number two, not understanding valuation caps. Some founders will set valuation caps too high or too low, and this can affect future fundraising rounds. Third, using a convertible note without a follow-up plan. Maturity dates is the key point here. Maturity dates can sneak up fast. If you can't raise your next round, investors may demand repayment or extract further dilution from you to extend the terms of the convertible note. So another pro tip here is use cap table tools like Carta, Cake, or Pulley to track how SAFEs and notes impact your ownership in future financing rounds. So let's recap. SAFEs are founder-friendly, they're not debt, they're best for early-stage startups. Convertible notes are debt-based, investor-friendly, and best for startups bridging to a priced round. Both can have valuation caps or discounts, but SAFEs are simpler, while convertible notes include interest and repayment risk. Founders should carefully track cap tables to avoid unexpected dilution. If you're raising capital, make sure you choose the right funding structure for your startup's future. Let me know if you'd like me to go over how to negotiate SAFE and convertible note terms in an upcoming video. Join me on the path to decoding law, technology, and innovation to grow your business. Don't forget to like, share, subscribe, and hit that notification bell. Until next time.